When it comes to whole life insurance, most people know by now that there is a cash value associated, both guaranteed and non-guaranteed. But what most people don't realize is that there is a way to accelerate the growth of the cash value in your whole life policy, giving you more liquidity use and control of that cash value while you're still alive, as well as the death benefit when you pass. Today, we're going to talk about how to accelerate the cash value growth within your whole life policy. Hi, I'm Olivia Kirk.
I'm Tim Urich. We're from Tier 1 Capital, and we're here to show you how to regain control of your money. So we've identified 4 areas where you could actually supercharge the growth of cash value in your whole life policy. And the first area is to get a limited pay policy. You see, most whole life policies are paid up at age 100 or age 121 with a long premium payment period. But if you want to grow your cash value faster, you compress that paid up period so that you have limited years to put the premiums into the policy, and that will accelerate the growth of cash value because the cash value basically has to be paid in a smaller window of premium payment years.
All right, so think about it. We still have the same age of mortality, that same mortality period of 100 or 121, but we only have a limited amount of time to make payments to that policy. In fact, we're not able to make payments past that amount of time, whether it's 8, 10, 12, 15, 20 years, or age 65 even. We're limited as to how long we're able to put money in, but the insurance company still has to make their second promise, right? They have to pay out the death benefit promise number 1, but they also have to have the cash value equal to that death benefit at the age of maturity, which is age 100 or 121. So by only putting in money for 10, 15, 20 years, the insurance company needs to calculate on a guaranteed basis how much growth needs to occur within the policy by that age of mortality.
That's correct. And let's make a distinction, because the time that the policy premiums stop is not the point where the policy matures. If you have a 10 pay, meaning that you're paying the premium in 10 years, it doesn't mean that the full death benefit is available in cash at the end of 10 years. It means that the premiums stop at 10 years and the death benefit and cash value will continue to grow so that at age 100 or 121, the cash value equals the initial death benefit when you started the policy. So that's one distinction. So the first way to accelerate the growth of cash value in your policy is to limit the payment years. The second way that you could accelerate the growth into a whole life policy is to add a paid up additions rider. Now, a paid up additions rider is literally what we said. You're buying a paid up death benefit inside the policy, the original whole life policy. So by putting that extra money, let's say it's $1,000, that might buy $25,000 of paid up death benefit. And what does that mean? Well, keep this in mind. At the age of maturity, that cash value of $1,000 has to equal the death benefit of $25,000. So you're going to get all of that growth pretty much guaranteed for the rest or the duration of that policy. So that's the second way. And keep this in mind, you also want to do it in a way where you don't give up the tax-free benefits of a life insurance policy. So what we're saying is you can put extra money into the policy, but yet that's limited based on the modified endowment contract.
So we're not able to put in an unlimited amount of paid up additions. We need to structure the policy properly so we are able to maintain those tax benefits, and that makes a lot of sense. And the paid up additions is a great benefit to a life insurance policy for that cash value accumulation, right? So a whole life policy is naturally going to become efficient over time. It's going to do so on a guaranteed basis, right? Because the cash value eventually has to equal that death benefit at the age of maturity. But with the paid up additions, we're able to build up that cash value more quickly in the beginning of the policy, right? So with a regular whole life policy, let's say paid up at age 100 or 121, there's typically no cash value within the first few years of the policy. But by putting on that paid up additions rider, we're able to build that pool of cash early on so we don't have that delay in the cash value benefits. And we are able to tap into that cash value earlier on in the policy.
Exactly. And that takes us to the third way where we can accelerate the growth of cash value in our whole life policy. And that is by adding a term rider to the policy.
Which kind of sounds counterintuitive, right? We're trying to build the cash value by adding something that has absolutely no cash value associated with it.
Exactly. But what happens is when you put that rider on the policy, it raises the ceiling, if you will, of death benefit. And that means we could stuff more paid up additions into the policy.
Because per age, right, your age and your death benefit, it determines how much cash value we're actually able to accumulate within the policy. But so by increasing that death benefit, right, we have no power over the age, unfortunately. But by raising that death benefit, we're able to put more cash value, more paid up additions rider on the policy. So we're able to accelerate those cash value benefits even more early on in the policy.
Think of it this way. If you put a term insurance rider on your policy, let's say it's $100,000, and what you're doing is you're putting paid up additions ultimately of $100,000 of death benefit. But what happens is as you put more money in, the amount of term insurance is bought down. So on day one, you have $100,000 of term insurance and zero paid up. But by the end, or by the time the term rider is completely bought up, you have zero term and $100,000 of death benefit on the paid up portion. Yeah. So you're literally swapping out term insurance with no cash value for paid up life insurance, which is significant cash value.
Exactly. And that type of rider that you're talking about, that term and paid up additions combination rider, right? They're tied together, is a great way. It adds a lot of flexibility to the policy. But then there's another design as well with a level term rider, right? So we'll buy 7 to 10 years of term insurance with a fixed rate, right? Keeping that term cost low. And then we'll also have a paid up additions rider tacked on. So they're two different riders, which adds a little bit less flexibility to the policy, but it certainly keeps the term cost lower in a lot of cases. And it just depends on your situation as to which design is better for you.
Which brings up a good point, because having an advisor or an agent who understands your situation and who fully understands what your intent or how you intend on using the policy is really the key factor, because they can custom design the policy to meet your specific needs and goals.
Yeah, so a lot of times, even with the level term rider that I was talking about, we have a low cost of term insurance, a little less flexibility, but we have the convertibility factor associated as well, right? So we're able to convert a piece of that term, lock in your insurability today, lock in that death benefit, and down the line, as circumstances change, maybe you have more cash flow down the line, you're able to convert that into its own whole life policy without having to go through the underwriting process again.
So that brings us to the next way you could accelerate the growth of your whole life policy, and that's through a 1035 tax-free exchange. So what does that mean? Well, basically, a 1035 exchange allows you to transfer money from one life insurance policy to another. Now, that's not always or necessarily a good thing, but let's say you have an underfunded policy, or you have a different type of policy other than whole life that you ran an in-force ledger and found that the policy is not going to last through maturity. Well, then you might want to take advantage of whatever cash value is in there, or save that cash value and transfer it over to a whole life policy. So now that money goes in literally as a single premium paid up life insurance policy under the umbrella of the existing whole life policy that you now create.
Yeah, let's take a step back there, right? So what we're saying in this case is we're exchanging cash value in, let's say, some type of universal life policy, right? Because the whole life policies do have that guaranteed cash value accumulation as well as that guaranteed death benefit. So in most cases, I could say it's not going to necessarily make sense to do a transfer of a whole life policy. There are situations where it can make sense, possibly if it's a mutually owned company or if it's not participating in dividends and you want to take advantage of those and you don't want to pay that premium on the old policy plus the new premium on the new policy. That may make sense. But typically with a universal life policy, it can become underfunded. Any type of universal life policy, it can become underfunded. And what that means is down the line, you may be looking at a situation where you have to decide, okay, do I want to lose all of the premiums I paid in, plus all of that death benefit associated with the contract, or do I want to salvage what's left and purchase a whole life policy and transfer that cash value so I don't lose it?
And I want to make a point here, and this is really important. Most people don't know the difference between universal life and whole life. And the best way to understand this or to figure it out, or to see which type of insurance you have, is request from your agent or from the company an in-force ledger statement. Basically, what that will do is give you a projection of how the policy may perform prospectively from today forward. And usually with that, you'll know exactly what type of insurance policy it is. And more importantly, you'll know how or if it's going to perform to what you originally thought or how you originally thought it was going to perform.
Right. So if you look at especially the guaranteed values, right? So on a guaranteed basis, is that cash value increasing every year? Or is there a point at which the cash value starts to decrease and then the policy eventually lapses? It's a great way to tell.
Exactly. So let's recap the 4 ways you could accelerate the growth in your whole life policy. Number 1, limited payments. Number 2, paid up additions riders. Number 3, a term insurance rider that allows you to put extra paid up additions. And finally, number 4, the 1035 exchange. Now, there's actually a 5th way, and that's a combination of all those 4, and then you have really supercharged or accelerated the growth of your cash value.
If you'd like to learn more about how to put these strategies to work for your specific situation, check out our website at tier1capital.com. Also, if you like this video, be sure to check out these 2. We picked them out special for you.
Thanks so much for watching our video. And remember, it's not how much money you make.
It's how much money you keep that really matters. We'll see you in the next one.